Hi, my name is Stephen Mullowney. I'm the Chief Executive Officer of TRX Gold. We are listed on the New York Stock Exchange American under the symbol TRX and on the TSX under the symbol TNX. We have an operating gold project in Tanzania, producing right now at 1,000 tons per day processing capacity with throughput producing 25,000 ounces, and we're growing that to 2,000 tons per day, which will double the throughput of the operation as we continually expand the Buckreef Gold Project in Tanzania. Hi.
Stephen, good to see you. Obviously, condolences. News on Friday.
Thank you.
A few words.
Yeah, thank you for that. Yes, our founder and chairman passed away on Friday. Caught us really off guard. Although he was 82, he was in relatively good spirits and good health, and he'll be greatly missed.
Okay, well, I think it's always worth acknowledging and saying.
Thank you.
You and your team. Now we've not met or spoken before, so maybe this will be a slightly, if you don't mind, longer session. I want to work out a little bit about you, the business plan, strategy, etc. So, first of all, where have you come from? What's your sort of relevant experience?
So I joined this company just over 2.5 years ago in December of 2020. So just after the pandemic, or the core of the pandemic, and moving into 2021. Prior to that, I was a partner and managing director at PricewaterhouseCoopers. I led the deals mining practice. In that role, I'd done a lot of M&A, capital raising, and a lot of advisory assignments as well, both on the operational and financial side of businesses. And I did that right across the world. So I had clients in the CIS, Russia, Japan, China, Indonesia, obviously Canada, United States, and into Europe as well. So I got a very broad-based sense of mining globally from that. And, it was a lot of interesting work.
Right.
And that was all before the world got the way it is today.
Yeah. No. So hopefully some of that allows you to actually work out what a good company looks like, and obviously why you got involved with TRX. Now, there's kind of been all change about 3 years ago in terms of the management and I guess the focus of the management. Can you tell us a little bit about that? Yeah.
So the management team is myself. We have a CFO who's a former Barrick executive, and Michael Leonard, a COO who is worked in both majors and in junior companies in Andrew Cheeto. In Tanzania, we have a Tanzanian native as our SVP in Tanzania. And then on the ground itself, we have a lot of people who came from other miners across Africa. So in Tanzania, what I call the social infrastructure is there, in which their universities have geology programs, metallurgical programs, and other mining disciplines. And what happens is they go work for the Barricks and the Anglos and start off there, work throughout Africa, and then they come back home. And so we have a lot of those people, and our general manager is one who worked and built Teranga's mines in Senegal, for instance.
Right, okay. Yeah, it's a great country. We've done some well-funded structures in country, good people, and a great place to work. And I'm sure you'll tell us about some of the other players in the country. I want to try and understand what you walked in with this new team trying to do. What was the brief day one compared to where you are today?
So the brief day one is, if you look at it, I put it into stages now. So the first stage was basically restructuring and rebuilding relationships. And so
why is that?
And so the company was around a long time. It's had this project since 2012, but it never developed it. And so in Africa, you need to develop your projects, whereas in North America, you can kind of sit on them a little bit longer. But in Africa, you need to develop it in order to build your social license. The gold's in the ground. They want royalties, taxes, and jobs from that gold, and start a development. And so the first part was the restructuring of that, rebuilding of relationships. So in that, we had to put in place brand new teams, look at a business plan that could come from a money-losing $500,000 a month operation into a profit, and then put in place, in which the second phase now is putting in place the longer-term value creation business plan. So when we looked at the $500,000 a month losing operation, the plan there was, let's put in place a small ball mill to make that from a money losing operation into a slightly profitable
But were
operation.
you losing money because it was going through exploration process? Because why?
No, it was in a test plant. The throughput wasn't high enough, and there was just too much G&A. So we wanted to put it, instead of retrenching, which then impacts your social license, we wanted to put in place a plan that would cover everything and not cost the company money each month. So we did that through an expansion to 15 tons per hour. We subsequently did another expansion to 45 tons per hour, 1,000 tons per day. And now we're currently undergoing another expansion to 2,000 tons per day.
Right. So yeah, the ambition was there early on. You saw that this needed to go on the front foot rather than back foot and hunker down. Okay. So you got 2 million ounces of M&I.
Yes.
Just over.
Yeah, in our 2020 resource state. Yes.
Absolutely. And I think there's about 0.6 on the inferred as well, right?
Yeah.
Since 2020, there's been much more expansion drilling or infill drilling.
So the drilling since 2020 has been mainly focused on extending where the ore bodies are. So our main zone deposit has been extended to the northeast as well as in the south. And we discovered an equal length trend 500 meters to that main zone in the Anfield trend that's anchored with the Eastern Porphyry and a defunct mine off the special mining license. And both trends are over 2 kilometers in length. So when we're talking about the resources, we're still only talking about the main zone. We'll have other zones on this property that are hopefully just as big or larger than those, but they got to be drilled out over time, the exploration dollars spent, which is currently coming out of the ground. Most of the capital right now is on the expansion. Then when that's done, we'll be back to the drill bit.
Right. So talk to me about how you see your allocation of capital across, there's a lot of things to tackle.
Yeah.
Right? You talk about scaling up, growing ounces produced, but you've also got to be mindful of the spend and what's the best use of spend right now in this economic climate and at your stage of development. So what does that look like for you at the moment?
So what it looks like for me when I look at allocation of capital is there's so much that comes out of the ground in profits. So the first allocation of capital is to get the economies of scale of a much larger plant, and they'll be there. And so we look at payback periods for that. And I like to have payback periods that are 6 months or less. So that sort of capital will be spent on that expansion first, and we'll ramp into that because the way we've done this is we've got 3 ball mills, small ball mills on site currently. We'll put in a much larger one with the same capacity as those 3. But the infrastructure around tanks and crushing and tailings and other infrastructure around mining aren't there yet. So we'll ramp up and take some of those smaller ball mills offline as we ramp in and build the remaining pieces of a much larger plant. And that works because from a power perspective, the much larger plant is much more economic from that perspective. And then we also have a stockpile with 10,000 ounces on it that we'll utilize and run through those plants as well as we move into mining fleet and taking care of that.
Okay, so talk to me about the balance sheet, okay? Because you're sitting with some oxide, but 90% of it is sulfide. That's right, okay?
Correct.
So in terms of met work, quite good, 88.7 on the sulfides.
Yes.
Is that about that? A little bit higher on the oxides?
Yeah, so we're about just over 80% on sulfides and 90% on the oxides, and so we're processing both now.
Right.
So we can do that, but in order to be really efficient in that, we need to upgrade the crushing circuit, which we'll do as part of this plant expansion. And those have been ordered. They should be on site in a couple of months, and that will then enable us to really optimize the mine plan between oxides and sulfides to maximize output.
So, and you can't really talk about recoverables without talking about payables and so forth. So in terms of operating in Tanzania, again, give us a sense of what that looks like, because you're reinvesting all of this.
Yeah, so operating Tanzania, what we've discovered is we like Tanzania from an operating perspective. So for instance, our tanks are all locally built.
Okay.
So there's shipbuilders on Lake Victoria who will come to site and build tanks and weld their tanks on site.
Right.
And they bend all the steel. So if you build ships, you can build tanks. It's pretty easy. They don't leak either.
Same thing.
Yeah, same thing. So we utilize a lot of local services. All the electrical components are done locally. Even right on down into the control panels are engineered and done locally. Now, obviously, we're a public company on the New York Stock Exchange, so we have an overarching Western engineering firm looking at all of that work as well. and doing the sign-offs on it. And then that's the way we build it out. So Tanzanians, they want to work, they do good work, and they can build in a very cost-effective manner. So we've been very pleased with that. And then we're 100% local on site. Our mining contractor is 100% Tanzanian. Our geology staff is 100% Tanzanian. Our general manager is Tanzanian. So it's been a good place to operate from.
Definitely. But coming back to the comment around, question around payables, I'm so intrigued because you've got you're producing ounces, which is great. I want to understand the margins involved, how much you're going to be reinvesting.
Yeah,
because that's the kind of driver for growth for you, isn't it?
Yeah, the driver for growth is the reinvestment. Look, we all know what type of capital cost environment we're in.
Yes,
it's not cheap.
Yeah,
capital isn't cheap. Even debt's not cheap. So the cost of equity is very significant. I think this is the first year in, say, 20 years that you're able to go in North America anyway and get over 5% GIC, almost up to 7%. So, there are places for people to put their money, so you better be growing. So from our perspective, we're currently producing between 20 and 25,000 ounces. That's what our plant will produce. Yeah, the 1,000 tons per day.
Yeah.
We'll double that. That will get between 40 and 50,000 ounces. We're looking at cash costs in the range of around $800 to $850 an ounce, all in sustaining cost of probably just over $1,000 to $1,100 an ounce when you add everything into it. So there's good margins here. But mining is a capital-intensive business, so you got good margins. You need to reinvest in tailings. You need to reinvest in sustaining capital. So once all of those investments are made, then the excess goes into continually expanding the operation or putting it in a drill bit. This next expansion will spring a lot more economies of scale, particularly around power and efficiencies in the processing plant. And so that will then be reinvested. There's so much drilling potential here and exploration potential. That needs to be unlocked. Right. And that's the future growth to get to our goal would be to have well in excess of 10 plus years of profitable production at well over 100,000 ounces. That's the ultimate goal. That's a valuable mining property.
It absolutely is. And I guess that's literally where it's going to go because I don't think you kind of got that production or producer re-rates in there because it's up 3 years for precious metals and all equities, quite frankly. But you've not seen that production re-rate. And I think people are going to be looking to you, okay, give me the scale. Okay, I want to see this 100,000 mark hit. And I want a sense of when that's going to be hit. I want a sense of the margins you're going to be able to achieve. Yeah. Presumably your AIC and your sustaining costs will come down as you get that scale too. Have you got a goal in mind?
Yeah, so what we'll do in the interim, obviously most people do this through studies and show the market what it can be through a study. So we will do a study over the next 6 to 12 months, more than likely a PEA type form study or pre-feas type study. The company had a pre-feas in 2018 prior to me and the new management team getting involved, but that needs to be re-looked at. The rules have changed. It's all about mineable ounces and things of that nature now, and in-pit and underground resources. So you get a sense of what it can be with what's the inventory is there currently. And then when you put the drill bit in and you continually find things, you keep on updating that. So there's lots of companies, well, actually there's 2 or 3 that kind of do that on an ongoing basis that have good valuations. Then you'll get a sense of the margins and the production profile and the cost. More importantly, the cost to get to those type of
I think the important thing is not only do you need to know that, but the market needs to know that too, right?
In order to value us.
Exactly, to value, because it's hard to do comps without it. So what gave you the conviction to actually move ahead without, being able to advise the market on those economics?
Quick paybacks.
Quick paybacks.
Okay.
Let's talk about that because that's really interesting. Because sometimes that's a real liability and a real danger.
Yeah.
The simplicity, because this is at surface and quite shallow.
Correct. Yeah.
Right. So strip ratio practically non-existent.
Well, it's under 5. Yeah.
Right.
Yeah.
So, but the point is, it's simplistic metallurgy, simplistic open pit mining, and reasonable grade. They've got this real mixture between, I guess it's greenstone, typical greenstone, some high grade veins and some homogeneous sort of
high grade areas.
Yeah. So you felt that there's enough case studies around and enough experience from, I guess, people so who's your Barrick guy? Was he CFO? Or
CFO. Yeah.
CFO, right, okay. There's enough experience to say, I think we can do this without mucking it up.
Yeah. So look, I look for projects that I can understand. So I'm not a geologist or an engineer, but I'm reasonably educated in those disciplines. I need to understand the metallurgy because in my role at PwC, I saw a lot of restructurings too.
Yeah.
And so what you learn from restructurings is what went wrong and what to look out for. Yeah. And so metallurgy is a big one. So this one's simple, grind, crush, CIL. Both oxides and sulfides. We're doing a variable met study now with SGS in South Africa, and hopefully that verifies it right across the deposit. So right now it's simple, straightforward metallurgy. It does come to surface, so that's great. You don't need to spend $50 million to get to the ore body, like some projects that I see. That's a major component of capital cost. And the grade profile decent for an open pit resource. So when you add all that up, your paybacks are pretty good. And that's part of the reason why the business plan has been, start small, de-risk it, grow it, de-risk it some more, and grow it again. Because if you try to, go and get it to 100,000 ounces right away, well, we've seen what happens in that environment. There's cost blowouts. Yep. There's delays. There's this, there's that. You got no cash flow to pay for anything until you actually get into production. It's tough. It's not an easy business.
It's not an easy business. I think, but we're seeing lots of people trying to come up with alternative strategies to kind of navigate this marketplace.
Yeah.
Okay? Because we're going for 100,000 out of the gate. That costs a lot of money. Yeah. A heck of a lot of dilution. It's part of your messaging here is we are cash producing. It will contribute towards our OPEX, and we will continue to be able to scale without raising money.
So if you look at one of the slides in our corporate presentation now, is what you'll see is one of the things I needed to do when I first came in is recapitalize the company.
Yeah.
It only had $2 million on its balance sheet. So we raised a net amount of $25 million. Our last raise was in January of 2 years ago.
Right.
So out of that $25 million, we have 7.5 on the balance sheet currently, and we've invested, I believe, as of Q3 2023, which would have been in May 2023, $37 million.
Okay.
So yes, that proves out. You take that net capital raised and you put it into production, then you get a multiplier effect on that. While at the same time, we've kept G&A's actually come down a little bit.
Okay. So your message to either shareholders and people looking in, because there's 70% retail, right? If there's a thing, are you looking to kind of change that as you kind of go through the?
I think that naturally changes over time. Right. As you become more valuable of a company, your market cap increases. Sure. You start to attract that institutional base. Yeah. And the retail base, but you can't leave the retail base alone. The retail base is always going to be extremely important.
So that liquidity and I guess a little bit of volume trading when you need it, as and when you need it, is good. So your message to them and people looking in, because I think, we're certainly very keen to point towards, late stage developers or producers in a market like this for retail. Yes. It's a safer bet. Your message to them is what? This will be slow but accretive growth over time. Don't expect any spikes like we saw in 2020, 2021. Is that the...
Yeah, I think that's going to be the current messaging in this environment, unless you see an opportunity that adds a lot of value from a shareholder value perspective. But it's got to add value to existing shareholders too.
Right.
In that. And you need to have that multiplier impact, right? So right now, the business plan is steady as she goes and continue to grow it.
Right. So the Ore Group are in country. They did a deal, didn't they? Well, say
Ore Corp. Yeah, they were just Ore Corp is an Australian listed. Yeah. They'll get almost 200,000 ounces out of the gate. Yeah. I think it's a $500 million project was sold to Silver Corp.
Yeah, that's right. Yeah. We spoke to them a couple of weeks ago in Beaver Creek, actually. So do you see opportunities in country, or do you feel that with M&A, is that balance between we've got stuff to do, let's get our head down and do that, versus we're opportunistic, because you've got to say that?
I would say we're opportunistic. Look, at the end of the day, you realize this and I realize this. A 110 million market cap company is good. Yeah. But you need to be larger to attract all the sources that want to invest in this space. And so you have to be nimble too in growing. You can't grow for the sake of doing transactions. So it is one industry too that 1 + 1 does equal 3 from a valuation perspective and a risk spreading perspective. But it would be those type of, I like messes a little bit more, and I like really clean things.
Yeah.
Because if it's clean, you're paying top dollar for it.
Yeah.
If it's a little bit underloved and a little messy, and you have the skill set to go in and change it, you can create a lot of value.
Yeah.
And so I think there are opportunities available, and we see more and more of those. I think, that we will look at that, but it's got to be accretive for shareholders and make a lot of sense. And then really, it's got to be within our skill set as well.
So stick to the knitting. I've seen instances the last couple of months where 1 + 1 = 1. So $200 million to $100 million companies equals one $100 million company.
Wow.
For some M&A.
Oh,
it's pretty bad, right? It's pretty
Oh.
there. So no one wants that. So stick to the knitting. Focus on this implementation. There's an upgrade we get to 2,000 tonne per day. Reduce those margins, ASIC, and the all-in, etc. Is that the goal for now?
That's the goal for now. And look, there's a couple of reasons driving that. And what I've noticed in the markets, and you've seen that because you just mentioned 1 + 1 = 1 or 0.5.
Yeah.
And I think this is a market where if you tell the market you have a liquidity problem or you need to raise capital in the future and create a liquidity overhang for yourself, oh man, it can punish you pretty bad in this market.
Yeah.
Yeah. Well, you got to try to avoid that.
Yeah, and I don't think the normal rules have applied for the last couple of years in this space. Yeah. Seemingly so. Fundamentals driven. We're going to be producing, throwing off cash. We're trying not to dilute.
Yeah.
Doesn't sound like you're going to dilute and grow this thing.
Yeah.
I like it.
So thank you.
Thanks for coming in and talking through that. We'd not obviously, like I said, met or spoken before, but it's an interesting approach to how you actually go and old-fashioned generate cash. It's nice.
It's amazing. You got to have a business there, right? You got to have a business, the purpose to exist.
Yeah.
Right? Or you have to show the market that you're going to be a business. Look, there's a lot of risk in this business. The metallurgy is one, obviously, the processing, the capital blowouts, managing all that is difficult, right? And what I say, we haven't made any mistakes. Yeah, we made a few mistakes, but they're not going to cost the company.
Right. Okay, well, stay in touch, okay?
Yeah. Thank you.